What is trading volume? Trading volume is simply the number of shares, contracts, or units of an investment that are bought and sold during a given period of time, usually measured daily. If lots of shares are changing hands, volume is high. If only a few trades happen, volume is low. Consider it a measure of market activity for a particular stock or investment. Why does it matter? Volume matters because it shows how much interest and activity there is in a stock. High trading volume usually means many buyers and sellers are paying attention. This makes it easier to buy or sell quickly, which is called liquidity. A liquid stock with high volume lets you trade without pushing the price around too much. Low volume, on the other hand, can make trading harder. Prices may move more sharply because there aren't enough trades to balance things out. For investors, volume reflects the market's energy. It shows the force behind price movements, not the direction itself. Here's a simple example. Imagine a company usually has about 500,000 shares traded per day. One morning, news breaks that it's launching a brand new product. Suddenly 5 million shares trade in a single day. That's 10 times the usual activity. The price might go up or down depending on how people feel about the news, but the high volume tells us a lot of investors are paying attention and rushing to take action. This is why traders often compare today's activity to the average daily trading volume ADTV, which shows what normal looks like over the last few weeks. What else should you know? Volume is often shown at the bottom of stock charts as vertical bars. Each bar represents how many shares were traded on that day. It's not just about individual stocks either. Bonds, exchange-traded funds, ETFs, and even cryptocurrencies all have trading volumes. A key detail is how volume interacts with price. If a stock's price rises on strong volume, investors may see that move as more reliable than if it rises on very weak volume. That said, high volume doesn't always mean good, and low volume doesn't always mean bad. A sudden spike in trading might simply be speculation or short-term noise, not a sign of lasting strength. For context, big companies like Apple or Tesla often trade millions of shares every single day, making them extremely liquid. A small penny stock might only trade a few thousand shares daily, which means it's harder to get in, or sometimes more importantly, out of the trade, without moving the price. Finally, professional traders often look for volume spikes, sudden bursts of trading that suggest a shift in momentum. But for long-term investors, volume is more like supporting information than a main decision maker in any meaningful way. To sum it all up, trading volume is the total number of trades happening in a given period. High volume usually means high liquidity and lots of interest. Low volume can mean less attention and potentially more price swings. It helps show whether a stock's price move is backed by a crowd of investors or just a trickle of activity. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.